Have you ever actually taken a moment and done the math on your daily life? You wake up early, get ready, maybe rush through breakfast, commute to work, spend 8 or 9 hours there, and then commute back home. By the time everything is done, you've easily spent 10 hours or more just working for money, day after day, week after week. But here's the question almost nobody asks while you're working that hard every single day. What exactly is your money doing during those same hours? Is it working with you? Or is it just sitting quietly in a bank account doing almost nothing? Because for most people, their money is not working at all. It's sitting in a savings account, earning maybe 1% a year, sometimes even less. And on the surface, that feels safe. The number isn't going down. There's no volatility, no stress. But what you don't see is what's happening in the background. Inflation, prices go up every year, food, rent, gas, everything. And if your money isn't growing at the same pace, you're actually losing value over time. Your balance might look the same, but what it can buy is slowly shrinking. So while you're working hard to move forward, your money is quietly moving backward. And that's the problem. Because if your money isn't growing, you're stuck in a cycle where you have to keep working harder just to maintain the same lifestyle. That's not progress, that's survival. The real shift happens when you stop thinking only about working for money and start building a system where your money starts working for you. Now I know what you might be thinking. Investing sounds complicated. It sounds risky. It sounds like something that requires constant attention. But the truth is, if your investments are making you stressed or keeping you up at night, that's not investing, that's a bad system. Real investing should feel simple. It should feel controlled. It should feel almost boring. Think about it like a machine. When you use a washing machine, you don't stand there watching it spin. You load your clothes, choose the settings, press start, and go do something else. After some time, it's done. That's exactly how your financial system should work. You set it up once, and then it runs in the background of your life. So let's make this practical. Imagine you have $10,000, not a massive amount, but enough to build a strong foundation if you use it correctly. The key is not putting all of it in one place, but dividing it into different roles, so each part of your money has a clear purpose. The first part is your safety net. This is your foundation. Life is unpredictable. Emergencies happen, medical expenses, car repairs, job loss, unexpected bills. If you don't have a buffer, you'll be forced to pull money out of your investments at the worst possible time. So the first step is to set aside 20% of your money, which is $2,000, as an emergency fund. This money is not meant to grow aggressively. It's meant to be available. You can keep it in a high-yield savings account or a safe short-term option. The return might be small, but the peace of mind it gives you is huge. The second part is your growth engine. This is where your money actually starts working for you. Around 60% of your total, which is $6,000, goes into this section. The goal here is long-term growth, not quick profits, not chasing trends, but steady progress over time. Instead of trying to pick individual stocks, you invest in broad market index funds or ETFs. This way, you're investing in the overall market instead of relying on a single company. Within this $6,000, you can split your investment into 70% stocks and 30% bonds. Stocks provide higher growth but come with ups and downs. Bonds provide stability and help reduce risk. Together, they create balance, so your portfolio can grow without extreme swings. Now here's an important point: don't try to time the market. Waiting for the perfect moment usually leads to inaction. A better approach is consistency. Instead of investing all $6,000 at once, you spread it out over time. For example, you invest $1,000 every month for 6 months. This reduces risk and removes the pressure of making a perfect decision. The third part is your opportunity fund. This is the final 20%, or $2,000. This money is kept flexible so you can take advantage of market drops. Because markets don't move in a straight line, there will be dips, sometimes big ones, and during those times, most people panic and sell. But if you have cash ready, you can do the opposite. You can buy when prices are lower. You don't need to predict the exact bottom. You just need to recognize when the market has dropped significantly, say 15% or more, and start investing gradually. Even if this money sits for a while, you can keep it in a low-risk option, so it still earns something. When you combine these three parts, safety, growth, and opportunity, you create a system that works in all situations. If an emergency happens, your safety net protects you. If the market is stable, your growth engine keeps compounding. If the market drops, your opportunity fund gives you an advantage. But having a system is not enough. The real challenge is sticking to it. Emotions are the biggest reason people fail in investing. Fear makes people sell. Greed makes people take unnecessary risks. That's why automation is so important. When you set up automatic investments, you remove emotion from the process. The system runs on its own. Over time, you also need to rebalance your portfolio. If stocks grow faster and your allocation changes, you bring it back to your original ratio. This keeps your risk under control and maintains discipline. Now let's talk about expectations. A balanced portfolio return around 6% to 8% per year over the long term. That might not sound exciting, but over time, it becomes powerful. Because of compounding, your money earns returns, and those returns start earning returns. In the beginning, it feels slow, but as time passes, it builds momentum. If your $10,000 grows at around 7% per year, it can double in about 10 years. Over 20 or 30 years, the growth becomes much larger. And if you keep adding money regularly, the results can be significant. But there's one more thing that matters even more: your income. Your ability to earn is your biggest asset. If you increase your income and invest more over time, your wealth grows faster. Think of it like this: your job is the fuel, and your investments are the engine. The more fuel you add, the faster the engine runs. At the end of the day, this is not about getting rich overnight. It's about building a system that gives you stability, growth, and freedom. It's about reducing stress and giving yourself more options in life. You don't need to be perfect to start. You don't need a huge amount of money. You just need to take the first step. Because the truth is, you will never feel completely ready. There will always be uncertainty. But that's not a reason to wait. Start small. Build the system. Stay consistent. And one day, you'll look back and realize that the moment you stopped letting your money sit idle and started putting it to work was the moment everything changed. Because in the end, it's not about how hard you work for money. It's about how consistently your money works for you. This video is for educational purposes only and should not be considered financial advice. Investing involves risk, and you should do your own research or consult a qualified financial advisor before making any decisions.